Be Wealthy and Smart, episode 1157.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to explore whether a recession is coming or not. And there's 3 different scenarios that are on the table, and we're going to review what each one of those mean. So first of all, there are a lot of economists and market forecasters arguing about whether there's going to be a hard landing, a soft landing, or no landing. Those are 3 different recession scenarios that they're trying to explain their point of view and why they think the economy is going to turn out that way. So the fact that 3 different scenarios exist means that there's a lot of confusion out there and nobody's really certain what's going to happen. So the first scenario is the hard landing scenario. This scenario says basically that the Fed cannot bring down inflation without causing the economy to go into a recession. The debate is over whether the economy will suffer a hard landing, which would be a worst case scenario of more unemployment. Maybe those people even think it's teetering on a depression. And because U.S. economic data over the last couple of weeks has run hotter than expected, the hard landing scenario doesn't look quite as likely as it did. Now, on the other side of that, a reminder came in Friday in the form of the Conference Board's leading economic index, which fell again in January. So that's telling us things were weaker than expected. Tim Quinlan and Shannon Seary, economists at Wells Fargo, said reasonable minds can disagree about whether the economy is headed for recession or a soft landing, especially after a recent run of strong data. The leading index is not waffling, however, and they believe this is still consistent with a recession. The leading economic indicators, or LEI, is a gauge of 10 indicators designed to show whether the economy is getting better or worse. It fell 0.3% in January after a 0.8% fall in December. And economist David Rosenberg, founder of Rosenberg Research and Associates, calls the LEI a 100% ironclad recession forecaster. Another thing they look at is the manufacturing activity, and that indicates that there is contraction. When you have the yield on the 10-year Treasury note, which is 3.8%, and that's trading below the yield on the 2-year Treasury note at 4.6%, that can indicate a recession. But having said that, it's not a very accurate predictor of recession. It's predicted more recessions than have really happened. The soft landing scenario is that market data has continued to be resilient, showing the economy is still strong with the jobs market being incredible and the economy adding 517,000 jobs, according to the January report, and the unemployment rate has fallen to 3.4%, its lowest since 1969. This has lifted the hopes that the economy can withstand the Fed's aggressive campaign of rate hikes. So investors and economists are looking at weekly jobless claims and other labor data for any sign of a shift. Quinlan and Seary said it's tough to have a recession with the unemployment rate at its lowest in a half century. If the economy is to avoid recession, employment will be the key. There were also January retail sales, which proved much stronger than expected, rising 3%, underlining the strength of the consumer and showing the economy continues to grow. But skeptics doubt that the economy can avoid recession, given how aggressively the Fed has attempted to slow the economy and raising rates from near zero to a range of 4.5% to 4.75% in less than a year. The full effect of those interest rate increases have not really been worked into the economy yet because there's a lag time, so they haven't really shown their full effect. Strategists at Glenmead said hopes for a soft landing have grown, but the cumulative effects of the Fed's rate hikes are likely to eventually stall growth. Then we have the third economic scenario. So we had hard landing, soft landing. The third scenario is called no landing. That means no recession at all, and that the economy is strong enough to withhold the Fed's rate hikes without going into a recession. A still hot labor market and healthy consumer are seen providing the fuel that allows the economy to grow and potentially accelerate. And while activity in the manufacturing sector may be contracting, the services sector, which accounts for around 80% of the economy, is still going strong. Optimism over a resilient economy may explain the continued outperformance of technology and other growth stocks in the face of a continued rise in Treasury yields. But the potential catch is that the economic resilience will make for sticky inflation. Investors have largely come around to the Fed's view that interest rates will need to rise higher than markets had anticipated just a few weeks ago. But now the Fed may move its own expectations even higher after the January Consumer Price Index and the Producer Price Index offered signs inflation is now retreating at a slower pace. A pair of regional Fed presidents on Thursday said they would have backed a half-a-point rise in rates at the central bank's January 31st to February 1st meeting, which saw policymakers deliver a quarter-point hike. Torsten Slok, chief economist and partner at Apollo Global Management, said the bottom line is that higher interest rates for longer is negative for consumer spending, CapEx spending, and corporate earnings. A no-landing scenario is bad news for stocks, particularly rate-sensitive tech and growth names, and in the end, only delays a hard landing. Well, I don't know if I agree with him on that. I think the no-landing scenario is saying that the economy is more resilient than we think, since the jobs market is so strong. As long as people are employed and have money to spend, they're able to withstand some of the interest rate rises. Since inflation's been trending down and some of the prices in groceries and gasoline we've seen trend lower, that has helped the average household overall. But there's still parts of the economy where people are really hurting, and layoffs are still happening. And I think the biggest wild card out there is the lag time. Because the Fed raised interest rates so fast, we really haven't been able to see the full effect of those interest rate increases yet. It's going to take more time to see the actual damage that the Fed may have done to the economy to really slow it down. So while there's three different scenarios out there, the hard landing, the soft landing, and the no landing, I'm kind of in the soft landing camp. I think there is going to be some softness in the economy, and I think those Fed interest rate hikes are going to catch up with us. But I don't think it's going to be a hard landing. I do think it's going to be a scenario that's actually attractive for investments, both stock investments and crypto investments, and ultimately even bond investments. So we'll keep following the story and reporting into you as the drama continues to unfold. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.